On Tuesday, U.S. President Donald Trump enacted his long-threatened and very severe tariffs on Canada and Mexico. At the time of recording this on Wednesday afternoon, it appears there are discussions going on between Prime Minister Trudeau and Donald Trump, potentially to find a compromise. So the situation could change quickly. But either way, there's no doubt further uncertainty ahead. The whole situation has left many Canadians, including Canadian investors, deeply worried. Here to help us make sense of it all is Andy Nasr, Chief Investment Officer at Scotiabank Global Wealth Management. He'll give us his insight on how markets may react, implications for things like interest rates and inflation, how investors might best manage through this, and much more. I'm Stephen Maurice, and this is Perspectives. Andy, welcome back to the show.
Thanks for having me, Stephen.
Always great to have you here. So we're recording this on Wednesday afternoon. I just want to sort of set the table for that. And I mention it because, as we know, things are evolving quickly and they can change quickly. In fact, we just heard that the U.S. is going to pause tariffs on the auto sector for 30 days. And there are other discussions going on. Prime Minister's talking to him, all that stuff. So who knows? By the end of the day, maybe the landscape has changed completely. That said, I don't think potential volatility and instability is going to go away anytime soon. So I think what you're going to tell us is going to be relevant.
Well, I hope it's relevant. It seems to me we're going off headlines that change minute by minute.
Exactly.
I think the playbook is kind of the same.
So I'd like to actually start out kind of even bigger picture than all of that, than what's going on minute by minute. You would have been through, over the course of your career, many different crises, big economic disruptions over the course of the last 20 or 25 years. Where does this fit in from sort of a historical perspective? How does this compare to some of those other things like the global financial crisis, the pandemic, other things?
When you kind of step back and you think of the implications of this, obviously in modern history, and even if you just think of the turn of the century, we had Y2K, we had everything that happened in 9/11 and the consequences of that, the global financial crisis, which at the time people dubbed the Great Depression 2.0. It felt like the Great Depression. Mm-hmm. And then, of course, we had the pandemic, and markets were remarkably resilient. Corporate profits were remarkably resilient. How investors reacted is a hallmark of that's just volatility, right? So we do see the market reacting to news, reacting to what's happening with the economy, but we always do manage to end up in a better spot when it comes to companies will figure out a way to adapt and they'll figure out a way to get through these things. The other lesson was that there are no easy fixes. So everything that we're talking about today in the United States, tariffs, what is the extent of the tariffs? What does it apply to? Are there going to be tax cuts that offset the tariffs and potentially usher in this era of U.S. exceptionalism, and never mind the spending cuts? Well, that's the rhetoric versus reality part. Mm-hmm. And the reality is, you think of the global economy, there's this pot of money that was affecting low single-digit growth. And everybody was really optimistic in 2024 because we just figured, the economy's not in bad shape, especially when you look at a lot of developed markets like Canada, the US, other parts of the world. And there was this view that now that inflation had come back down, or at least it looked like it was coming back down, interest rates were going to get a little lower. That would grease the wheels of the economy, cause this credit growth, make everything kind of a little bit better in 25, a little bit better in 26. And then we had this tariff scare. And these tariffs, well, it's different. It's different because it's policy, but we know what the impact is going to be. And our Scotia economics team, they've done an amazing job quantifying this, right? They tell us clearly, and we know this. We know that if tariffs go in place, there's going to be higher inflation as a result of it. It is a tax. We know that central banks that were lowering interest rates to try to support the economy, well, maybe they stop because they're not sure how inflationary these tariffs are going to be. We don't even know what they're going to apply to your point at the beginning of the show. And then, of course, there's going to be an impact to economic growth. That's the initial take. Mm-hmm. But the real challenge here is how long do these things remain in place? Because if they remain in place long enough, meaning if they are in place beyond a quarter or two, and by the way, that is most investors' expectations. You look at markets, they're not pricing in 25% tariffs with retaliation. Equity markets seem to be okay. They've sold off a little bit. Fixed income markets, again, we're not seeing interest rates really decline a whole bunch because of that safety trade. That's usually what people pile into. But if this lasts a lot longer, then that policy indecision or that lack of policy clarity really starts to affect all economic participants. Households are going to spend less money. Businesses are going to spend less money. Very simply, if we were thinking of investing in the US, how long are the tariffs going to be there? What happens in 4 years? And we're making medium to long-term capital allocation decisions. So there is no easy fix with this. It's not like the global economy is going to really benefit from it. And the longer it lasts, the more impactful it becomes. So if you flash forward to, this lasting a little bit, what is the end result? Well, GDP growth is a lot worse. Interest rates and inflation both decline a whole bunch because this will cause demand destruction. And in that scenario where you have the initial impact of the tariffs, meaning that they're announced and some version of them is implemented, let's say it's that worst case scenario, and then the end result where GDP growth declines and you start to see interest rates and inflation decline alongside of it. Well, that unknown period is where investors might get jittery and we might see volatility go back up.
Mm-hmm.
And just remember, when you think of investing, there's two major asset classes. There's equities and fixed income. Equities bounce up and down when people start to get worried about the business cycle. The average intra-year correction for equities is 10 to 15%. We're not there. Right? There could easily be another 10% downside in equity markets if people really start to get nervous about this. But the headlines that we're reading, the analysis that we've done, nothing suggests that these tariffs should be in place for a prolonged period of time because I think everybody understands that if they are, nobody benefits, meaning there are no shortcuts.
Okay. So you mentioned that the markets did react initially after Trump made clear on Monday that the tariffs were going to go into effect. So Monday and Tuesday, markets took a bit of a hit. Today, Wednesday, they seem to be bouncing back somewhat. So maybe there is this expectation, basically, as you just laid out, that leaving these things in place for the long term is not good for anybody. But the uncertainty is still there. So what are you hearing from your clients, from investors right now?
So I think it's a couple of things. One is this is an administration that does have a history of being a little bit more bold vocally versus, the practical reality of what ends up happening. So I think now it's hard to separate the positioning and the posturing versus what ultimately gets put in place. And do we think tariffs will get put in place? Yeah, some form of them will. But we don't think it's going to be this worst case scenario because, again, it just doesn't benefit anybody. So there are a lot of clients that are concerned about this. Our wealth clients are worried about what does it mean for the Canadian dollar? What does it mean for the Canadian economy? Our commercial and corporate clients likewise are thinking, do we move capital to the US? Do we take advantage of a lower corporate tax rate? Do we even want to be in Canada? And the reality is that everything should ultimately sort itself out, right? That old adage, capital flows where it's used best, is true. You think of what's happening in the US, and I'm not sure that the US economy, which is running substantial fiscal deficits, you look at what's being proposed, none of this really makes those deficits narrow significantly over a medium to long-term time horizon. So when you talk about these tax cuts being put in place or tariffs or the US having a competitive advantage, it's not likely a sustainable medium to long-term competitive advantage. So when you think of it that way and what we would do for clients when it comes to positioning, the conclusion's the same. The conclusion was the conclusion that we had before we talked about tariffs. The conclusion was that the economy is going to make its way through this. We'll get back to some kind of resumptive growth. We hope that we have policy support if we need it. And before tariffs, the policy support was maybe central banks cut interest rates a little bit. Now it might be that maybe they soften their stance on tariffs. Maybe central banks do at some point cut interest rates to try to, again, spur spending and lending. But if you're thinking of those two major asset classes, equities are tied to corporate profits. A little context is really important here. And the context is, even in a recession, corporate profits decline by 10, 15%. Now, it doesn't seem like that, right? In a recession, you see markets go down 30%, some stocks go down even more than that. And again, this is where it's really important to distinguish between the value of a company and the sentiment around investing in that company. So what we want to try to do for clients is lower the risk of the portfolios not being able to handle that volatility. And that's why we always tell people, be diversified across asset class, be diversified across geography. And the same thing really applies to business owners too, right? You want to think of business diversification strategies. And by the way, everything happening in the US, let's not forget about what we went through in the pandemic. In the pandemic, we were all panicked about supply chains. And these companies were literally scrambling to diversify their supply chains. And it's the same kind of thing here, right? Of course, it's important to be globally diversified and globally competitive, but it's not like all of the money is moving to one region and it's going to stay there. So there are knock-on impacts. And when you think of positioning portfolios, we may see a little bit of corporate profit volatility. Corporate profit estimates this year, you look at Canada, the United States, internationally, there's this expectation that corporate profits grow around 10%. A little bit lower than that in some regions. Could that number be 5? Sure. Could it be 0? Maybe. Is that the end of days for investing in equities? Not even close. Let's not forget, equities are a remarkable hedge against inflation. That's what equities are known to do. And then you think of the other part of the portfolio, this fixed income part. So let's walk through the with tariff or no tariff scenario. Without tariffs, we knew that interest rates were going to kind of remain where they are or maybe decline a little bit. So if I'm a fixed income investor, that's great. I can get a 4 or 5% yield, and if interest rates decline, my cash flows become worth more, and I get a capital appreciation kicker because as interest rates decline, I see the price of these bonds go up. That's amazing. That's ballast in a portfolio. That was great to own before we talked about tariffs in 2024. It's almost even better to own now because if the economy gets really wobbly and inflation declines because of that demand destruction and interest rates get cut, guess what? You have more of a capital appreciation kicker and you get to lock in some really good yields. What happens with equities, if those equities go on sale, the risky assets go on sale, we take that money and we tactically redeploy it. So we end up with better compound growth for our clients. That's the playbook. That's as simple as it is. And whether it's fixed income or things like alternative investments, we're lucky to have great partners in asset management that have amazing solutions that we can use. But the idea is that diversification across geography, not just owning Canadian stocks, not just owning Canadian bonds, across asset class, again, being globally diversified, it really helps reduce the overall volatility of that portfolio, meaning how much the portfolio bounces up and down. And it gives us all a legitimate shot at achieving our goals and objectives over a medium to long-term time horizon. And if we think that these things are going to remain in place and remain in place for a while, that's just not likely going to be the case.
Okay. People are still going to be worried regardless. And that ranges across all the different types of people you were talking about, from a small investor, somebody with mutual funds or whatever, just saving for their retirement, to corporations trying to figure out what to do with their capital and so on. Maybe stick at the lower end of that for like sort of regular people. What would you say to them right now? What is the guidance in a situation like this that you would give?
So for any investor, when you create a solution for the investor, you always try to think of matching that with your risk tolerance and your time horizon. Mm-hmm. So if you're a younger investor and you're starting out and you know that, I'm going to pick an age, let's say you're 25 and you're going to retire at 65, 40 years.
Yeah.
This will be a very, very small time period.
Hopefully a blip.
A blip in that 40 years. Yeah. And most of these kinds of things most corrections are, recessions only last 12 months. So of course you want to try to position yourself for it, but if you don't need the liquidity, then you can ride this out, right? But you just want to make sure that you don't have all your eggs in one basket. And then again, if you're closer to, let's say, decumulation, where you might need the money or you need the cash flow coming from the portfolio, there are also things that you can do to rebalance that portfolio to make it become a little bit more defensive. And that's really the value of the advice that we provide our clients. It's not you own some stuff and you're going to hang on to it forever. It should really match what's happening in your personal life. It's that personalized approach to wealth management that really is important when it comes to thinking of the portfolios.
Okay. How do you sum that up then?
So I think there's a lot of noise. Now, again, you think of investing. What do we do when we're investing? Well, we're finding opportunities that exist in the market. We're thinking of how do we take our money and make our money grow over a medium to long-term time horizon. And again, if you're really nervous, what do you do when you're really nervous? Well, you want to buy the stuff that doesn't bounce up and down a whole bunch and is pretty safe. So things like fixed income, things like alternative investments, they do provide you with a little bit of that ballast and protection. So you can reorient your asset mix if you are that nervous and you don't really want to ride out the next couple of quarters or the next few quarters. The biggest challenge, the biggest mistake that investors make, Stephen, is always trying to time the market.
Right.
You could have had the same conversation a month ago or 2 months ago or 3 months ago, and you could have panicked. You could have sold everything. Would you have been any better off? Well, again, it depends on what you owned and how the portfolio was positioned. But the minute that this panic starts to creep in and people say, I'm just going to sell and I'll get back in later, in this case in particular, this isn't a business cycle issue where we have a recession. These are policy-induced fears. And I think what we're seeing with these headlines, hour by hour, day in, day out, is that they can change pretty quickly. And there may not be all that much to worry about in the grand scheme of things, because let's not forget, you look at the US and, there's this view that the market will act as a guardrail that guides the policy decisions in the United States, meaning, are they really going to go through with these tariffs? Well, maybe if the market declines by 10 or 15%, they might backtrack because they'll gauge investor sentiment and they'll say nobody likes these things. And of course, there's a corresponding wealth effect of what happens when markets decline. So there's always that. And I don't think anybody really wants to push us to the brink of a recession, whether it's a recession in Canada or even deteriorating economic growth in the US. This can get pretty messy pretty quick if retaliation is involved. So I think there's a certain element of logic that has to prevail here. So when you think of how to position for things, I don't think you want to go to one extreme or the other. You don't want to take on a whole bunch of risk. That's not really prudent in this environment. Conversely, you don't really want to get rid of everything because there's stuff that you can own and get a pretty decent return. And again, stuff that will actually benefit if volatility escalates. So the answer is somewhere in the middle, and it largely depends on your preferences, your risk tolerance as a client.
So I get the sense that principles that you've talked about in previous episodes on the show, diversification, don't try and time the market, even in a situation like this, which is not economic cycle related, but rather policy driven, even in a situation like this, some of those broad principles can still apply.
They absolutely should.
But even with those uncertainties in mind, and this would be my last question for you, how would you sum up the time we're in? And maybe that's a callback to the first question about comparing some of those other crises.
Yeah, it's always easy to kind of look at these events in isolation and in hindsight. So in hindsight, were the fears that we had about these things that were going to reshape the global economy, were they overblown? I mean, yes, to some extent they were when you look back. But when you're living it, it doesn't feel like that. And I think we're all going through this period of, it's very unusual, right? And again, it's much more broad than U.S. policy. I mean, this is global policy, and it's very geopolitical. So I think this level of unease is somewhat understandable. But at the same time, because it's not this what we would categorize as systemic risk, this thing that will unravel the fabric of the financial system, it's really one of those things that there's going to be a price adjustment. We'll figure out how to get around it. In one way, shape, or form, businesses are going to reallocate capital and figure out how to get around it. Because remember, businesses want to make money. They want to make their shareholders happy. If you're an equity investor, you're a shareholder. So you think about all that, and of course, there's the unease, but at the same time, separating the fundamentals, and fundamentals are still kind of okay, from the things that people worry about is what's going to be that much more challenging in the next quarter or two, next month or two. So I think if we have cooler heads and we're able to identify opportunities in that time period, then we're all better off for it.
What should people take away from this conversation, Andy?
Live for today, plan for tomorrow. It's that simple.
Andy, thanks a lot for coming. Always a pleasure to have you on the show.
Thanks so much.
I've been speaking with Andy Nasr, Chief Investment Officer at Scotiabank Global Wealth Management. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time. This podcast has been prepared by the Bank of Nova Scotia and is provided for information purposes only. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments, including ETFs. Please read the prospectus before investing. The indicated rates of return are the historical annual compound total returns, including changes in unit values, and reinvestment of all distribution does not take into account sales, redemption, or option charges or income taxes payable by any security holder that would have reduced returns. Mutual funds and ETFs are not guaranteed. Their values change frequently, and past performance may not be repeated. Views expressed regarding a particular investment, economy, industry, or market sector should not be considered an indication of trading intent of any of the mutual funds managed by 1832 Asset Management LP. These views are not to be relied upon as investment advice, nor should they be considered a recommendation to buy or sell. These views are subject to change at any time based upon markets and other conditions, and we disclaim any responsibility to update such views. To the extent this audio contains information or data obtained from third-party sources, it is believed to be accurate and reliable as of the date of publication, but the Bank of Nova Scotia does not guarantee its accuracy or reliability. Nothing in this podcast is or should be relied upon as a promise or representation as to the future. The information provided is not intended to be investment advice. Investors should consult their own professional advisor for specific investment and/or tax advice tailored to their needs when planning to implement an investment strategy to ensure that individual circumstances are considered properly and action is taken based on the latest available information. Scotiabank includes the Bank of Nova Scotia and its subsidiaries and affiliates, including 1832 Asset Management LP and Scotia Securities Inc. Scotia Global Asset Management is a business name used by 1832 Asset Management LP, a limited partnership, the general partner of which is wholly owned by Scotiabank. Registered trademarks of the Bank of Nova Scotia used under license.